lay out pretty clearly in the release what happened. There was a slight decrease, 3% decrease in earnings per share year over year, lower operating income and higher taxes that were partially offset by what?
Well, we had $151 billion of inflows, record amount of inflows, of which $87 billion was institutional and $73 billion was active. It was
and we should point out, too, $6.8 trillion with a T in assets under management right now.
And year-to-date, assets are up $866 billion.
Why?
Well, markets are higher, and especially markets are higher in the United States versus elsewhere. I mean, one of the key things about the quarter, our average assets for the quarter were $200 billion lower because of the market swoon in May, and obviously came back all the way. But probably one of the more interesting points about how I want to frame everything is 10 years ago when we bought BGI, about 49% of our business was in the U.S. And one would have thought 10 years later, as the world got healthier and bigger and broader, you would have thought that that percent would have shifted downward a little bit. Mm-hmm. And right now, it's about 66% U.S.
Wow.
So, and that's just telling you how much market beta has been in the United States versus the emerging world. Mm-hmm. In the second quarter, we saw that very large because we had emerging markets were down 7% for the quarter, and yet S&P was up approximately 7%. So we had a lot of divergent beta, and we saw a lot of de-risking still. We're still seeing, you know, we had $26 billion of increase in cash. So we saw people de-risking still, and I still believe, as I said last quarter, I think this is going to be a mistake. People are underinvested in equities. And I do believe with now the changes of tone of central bank behavior, and you're starting to see corporate earnings are coming in pretty well, you know, we still are constructive on the world. We had great active flows, as I said. We actually had active flows in equities in the second quarter, which was very unusual. We actually raised a $1.6 billion closed-end fund in equities. Yep.
But you could never be a sell-side analyst because you actually said something last time you were on. You actually took a position,
right? And
I mentioned it earlier.
Right.
And I'll bet you got some flack, too, because the headline was Larry Fink predicting a melt-up, not a meltdown. And there's so many people that are sure that this is all artificially Fed-induced gains and that the fundamentals don't match up with the equities. For you to say that, you put yourself out on a limb and really stuck your neck out. Like I said, a sell-side analyst would be, wow, you know, it might go up, might go down, could stay the same. You know, they never say anything because their main thing is keeping their job. But I thought you probably got some flack for that, but you were right. And now you're saying it again,
yes,
which is significant. Even at these levels?
At these levels.
You still think there could be a melt-up, or at least maybe not a melt-up, but trending higher?
Markets are going to trend higher. I do believe if you wanted to, you know, frame where the market's going to be for the next 10 years, I would be betting on the rest of the world will catch up somewhat to the U.S. when you see these big shifts. So much of the market gains have been U.S., which for good reason.
We deserve it.
We deserve it. We have better companies. We deserve it also because we did more fiscal policy than other countries. Other countries were heavily reliant on just monetary policy.
Right.
And I think that's going to be the issue. I know that you know, we're all anticipating a change at the ECB. I hope Christine Lagarde actually pushes some of the governments to start focusing on more fiscal policy.
Is it definitely her?
I hope it is her. I think it's highly likely.
I'm not optimistic about her.